Stop buying stocks right now. Did you know that over 70% of individual investors lose money each year? If you're feeling frustrated or overwhelmed trying to pick the right stocks, you're not alone. The truth is the traditional approach to investing might be doing more harm than good. Instead of chasing after uncertain gains, there's a smarter way to grow your wealth in 2025. Want to know what it is? Hit that like button and subscribe. Trust me, you don't want to miss this. Now, let me show you why this is so urgent and what you need to know before you start your next move. Stop buying stocks right now. Instead, I'm going to show you what you should be doing in 2025 to grow your wealth effectively. If you've been investing based on the typical advice, buy low, sell high, pick individual stocks, you're probably frustrated. And that's because the traditional approach often leads to losses, especially for beginners. In today's uncertain U.S. economy, with inflation, market volatility, and changing policies, blindly investing in stocks can be risky. That's why it's crucial to understand what's really happening behind the scenes before making any moves. This video is perfect for beginners and intermediate investors who want to protect their money and make smarter choices. You'll learn a clear, step-by-step strategy that can help you grow your wealth in 2025 without falling into common traps. By the end, you'll have a better grasp of what to focus on and what to avoid so you can make informed decisions moving forward. And remember, the key to successful investing isn't just about what to buy or sell, but understanding the economic environment that influences the markets. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Stop buying stocks right now. Instead, focus on understanding the current economic environment shaping the market in 2025. According to the Federal Reserve, inflation remains elevated at around 4.5%, well above their 2% target, driven by ongoing supply chain issues and strong consumer spending. The Consumer Price Index, reported by the Bureau of Labor Statistics, shows that housing costs and energy prices continue to be significant inflation contributors, affecting consumers' disposable income and investment decisions. Interest rates have risen sharply over the past year, with the Fed increasing rates from near zero to around 5.25%, aiming to control inflation. Higher interest rates make borrowing more expensive, which can slow economic growth and impact corporate profits and stock valuations. Meanwhile, the tax landscape is shifting with proposals for increased capital gains taxes and adjustments to corporate tax rates, potentially reducing after-tax returns for investors. The housing market is also cooling after a pandemic-driven boom, with home prices stabilizing or declining in many regions, influencing consumer wealth and spending patterns. These macro factors, persistent inflation, rising interest rates, potential tax changes, and a shifting housing market, create a complex environment that can negatively impact stock investments if approached recklessly. Understanding this backdrop is crucial because it explains why traditional buy low, sell high strategies may not be effective right now. Instead, investors need to adapt to these conditions to protect and grow their wealth. With that context in mind, let's break down a strategy you can actually apply. Stop buying stocks right now. Instead, in 2025, there's a smarter way to grow your money that doesn't rely on traditional investing. The main idea is to focus on protecting your wealth first, then making it work harder for you through strategic financial moves. This process starts with understanding that buying stocks can be risky, especially when the economy is uncertain. Instead of just buying shares and hoping they rise, you'll want to use a step-by-step approach called wealth preservation. This involves shifting your focus from simply investing in a market to controlling your financial environment. One key term to understand is cash flow. This is the money you have coming in and going out. Managing your cash flow carefully means making sure your income exceeds your expenses so you can save and invest wisely. Another important concept is assets, which are things you own that can generate value, like real estate or businesses. We'll also talk about liquidity, which is how quickly you can turn your assets into cash if needed. The idea is to build a foundation of financial stability before taking bigger risks. This might involve reducing debt, increasing savings, and investing in assets that are less affected by market swings. The goal is to create a resilient financial position, so when the economy shifts, your wealth remains protected and can grow steadily. Now, let's look at a real-world example to see exactly how this plays out in practice. Imagine you're considering buying a rental property in 2025. Let's say you find a house listed at $300,000, and after negotiating, you secure it for $290,000. Using Zillow's estimates, the monthly rent could be around $2,200. To finance it, you put down 20%, so $58,000, and take out a mortgage for the remaining $232,000. At current interest rates of 6%, your monthly mortgage payment, principal and interest, would be roughly $1,392, according to mortgagecalculator.org. Now, subtract the mortgage payment from the rent. $2,200 minus $1,392 leaves you with about $808 per month in gross cash flow. To be thorough, you also account for property taxes, insurance, and maintenance, which might total around $400 monthly. That leaves you roughly $400 in net monthly income. Over a year, that's around $4,800 in net income, providing a steady cash flow. Plus, the property might appreciate modestly, say 3% annually, adding to your wealth. If property values increase, your initial investment gains value, and rental income helps cover the mortgage, reducing your effective cost over time. This scenario demonstrates a low-volatility, income-generating asset that can help preserve wealth in uncertain times. But remember, this looks great only if you avoid the common traps that ruin deals like this. Stop buying stocks in 2025. Instead, focus on protecting your wealth from common pitfalls that can derail your success. One critical mistake is rushing into investments without understanding the real risks involved. I've seen many people jump into the market, hoping for quick gains, only to face sudden downturns that wipe out their savings. Another mistake is overpaying for assets, especially when emotions drive decisions. Paying too much for a property or a stock can diminish your future profits and leave you vulnerable. A third error is neglecting due diligence, failing to research thoroughly, which can lead to investing in unstable companies or overvalued markets. For example, a friend bought a property thinking it was a safe bet, only to discover hidden expenses that reduced his income. Lastly, ignoring the broader economic environment is a costly mistake. Rising interest rates, inflation, and legislative changes can quickly impact your investments if you're not prepared. To avoid these pitfalls, start by building a solid financial foundation. Focus on controlling your cash flow, reducing unnecessary debt, and increasing your savings. Invest in assets that are less volatile, like real estate or small businesses, which can generate steady income and appreciate over time. Remember, protecting your wealth in 2025 means making smarter, more informed decisions rather than chasing quick profits. To avoid those mistakes, here are the best tools and resources available right now. Stop buying stocks in 2025. Instead, focus on protecting and growing your wealth with smarter strategies. The first step is understanding where to find reliable tools that support your financial goals. Websites like Mint.com help you track your cash flow, giving you a clear picture of your income and expenses, so you can control your savings and reduce unnecessary spending. For managing debt and improving your credit score, CreditKarma.com offers free credit reports and tailored advice to help you lower interest rates and avoid costly mistakes. If you're considering real estate as a safe investment, Redfin.com provides up-to-date property listings, market insights, and valuation estimates, helping you identify assets with potential for steady appreciation and rental income. For educational resources and financial planning, Investopedia.com offers comprehensive articles and tutorials on how to preserve wealth, manage risks, and avoid common pitfalls in uncertain economic times. These platforms support a strategy centered on controlling your cash flow, minimizing debt, and investing in assets less volatile than stocks. By leveraging these tools, you can make informed decisions and build a resilient financial foundation for 2025 and beyond. Now that you've got the tools, let's talk about the first thing you could do today to get started. Review your current cash flow using Mint.com, set a budget, and identify areas where you can cut unnecessary expenses. Taking this initial step will put you on the path to safeguarding your wealth in a challenging economic environment. Stop buying stocks in 2025 and start taking control of your financial future today. Instead of jumping into the unpredictable world of investments, why not begin with a simple, manageable step? Take 5 minutes now to check your credit score. Download a free app like Credit Karma or Mint. Seeing your current credit standing is empowering because it gives you a clear picture of where you stand and what you can improve. This small action unlocks your ability to make smarter financial decisions, qualify for better loans, and reduce unnecessary expenses. It's the foundation for building a stronger, more resilient financial plan. Once you see your credit score, you can list your monthly expenses. Understanding exactly where your money goes helps you identify areas to save, reduce debt, and free up cash flow. Or, if you prefer, simulate an investment. Use online tools to see how small, steady contributions to real estate or small businesses could grow over time. These steps create momentum. They turn vague hopes into concrete actions. Remember, every successful long-term journey begins with a single step. Taking that first small action today sets the stage for lasting financial stability. Imagine what's possible when you stay consistent, building wealth, reducing stress, and securing your future. So, start now. Check your credit, list your expenses, or simulate an investment. This is how you begin transforming your financial story, one realistic step at a time. Imagine yourself 10 or even 30 years from now, having built a solid financial foundation through consistent, smart choices. Instead of chasing quick gains in the stock market, you focused on controlling your cash flow, reducing debts, and investing in tangible assets like real estate or small businesses. Over time, those efforts compound. By 2035, you could own 5 cash-flowing properties that generate steady income or have a diversified portfolio that steadily appreciates in value. This isn't about overnight riches. It's about steady growth and financial security built on patience and discipline. In 30 years, your investments and properties could provide a reliable income stream, freeing you from worries about market volatility or economic downturns. Compound growth, combined with consistent actions, transforms your small steps into significant progress. The key is to prioritize preservation and steady accumulation rather than risky, impulsive trades. And now that you see what's possible, here's how we wrap this up and take action. Start by reviewing your finances, managing your debts, and exploring income-generating assets. Small, consistent steps today lay the groundwork for a more secure and prosperous future. The power of patience and persistence can turn your financial goals into reality. So begin now and watch your wealth grow over time. Stop buying stocks in 2025 and start focusing on smarter strategies that protect and grow your wealth. Remember, more than 70% of individual investors lose money each year by following traditional advice, so it's time to shift gears. Instead of risking your savings in volatile markets, control your cash flow, pay down debts, and build up reserves. Consider investing in tangible assets like real estate. Imagine purchasing a property for around $290,000 that generates $400 a month in rental income and appreciates 3% annually. Use tools like Redfin or Investopedia to evaluate opportunities and monitor your finances. Small steps, like checking your credit score or listing your expenses, can create momentum toward financial independence. Long-term success comes from consistent, disciplined actions, controlling your money, reducing risks, and investing in assets that stand the test of time. Remember, in 10 or 30 years, these habits can lead to a stable, growing nest egg. Thanks for watching, and I hope you're feeling motivated to take control of your financial future. If this resonated, hit that like button, subscribe for more tips, and comment below. What's your first financial goal for this year? Want more insights? Check out our related video on building passive income streams. Stay confident, stay disciplined, and I'll see you in the next one.